Most people don't realize it, but the key to building wealth isn't hitting a home run with the next big stock. It's mastering the quiet, almost boring power of compounding. And most people don't even know how to do this, especially younger people like myself. So picture this. You're investing just $100 a month, and at first it feels like nothing is happening, but give it time and something incredible starts to take shape. Your money grows, and then the growth earns even more growth, and suddenly, what seems small becomes life-changing. It's not luck or magic, it's just math, and so many young people today don't understand the power of compounding. Today we're going to break down how compounding works, why it's the most powerful tool in investing, and how you can use it to build a future where your money works harder than you do. So let's go ahead and get started. Compounding is the secret weapon of investing. It's the idea that your money earns returns, and those returns earn even more returns, creating a snowball effect over time. And yes, the earlier you get started, the better. For example, if you invest $100 a month in an index fund that grows at an average annual rate of 8%, after 10 years, you'll have invested $12,000, but your portfolio will be worth over $18,000. The extra $6,000 is the result of compounding working its magic, and that's just a small example. Realistically, you're going to be putting more into it, right? Now, stretch that timeline further. If you keep investing $100 a month for 30 years, you'll have invested $36,000. However, at the same 8% growth rate, your portfolio will grow to over $150,000. That's more than quadruple your initial contributions, all because your returns are constantly reinvested, generating even more growth. The beauty of compounding lies in its exponential nature. The earlier you start, the bigger the impact. Let's say you start investing $100 a month at age 25 and don't stop till 35. Over 10 years, you'll have invested $12,000, but by age 65, your portfolio could grow to nearly $200,000, assuming an 8% return, even if you don't invest another dime after 35. Now, how do we get this 8% a year on average? I'll talk about that a little bit later. But compare this to someone who starts investing $100 a month at age 35 and continues until 65. Despite investing for 30 years, $36,000 total, their portfolio will only grow to about $150,000. This is why time in the market beats timing the market. Compounding rewards patience and consistency, not perfection. It's a long game that makes your money work for you, turning modest investments into life-changing amounts of wealth. Whether you're starting with $10, $100, $1,000, the sooner you begin, the more powerful compounding becomes. It doesn't matter how small the amount is. It's what so many people don't understand. It's simple math, but the results can feel like magic. The history of investing also has some interesting things to it that should make you feel more safe if you have a long time horizon like myself. So, modern investing as we know it began in the 17th century with the Amsterdam Stock Exchange, the first organized stock market. Since then, markets have experienced cycles of incredible growth and devastating crashes. One of the best periods for investors was the post-World War II era, particularly the US stock market's performance from 1945 to 1965. During this golden age, the S&P 500 saw a consistent annual return of over 10%, fueled by economic expansion, technological innovation, and a booming middle class. Another standout period was the 1980s and 90s, when markets surged thanks to declining inflation, lower interest rates, and the rise of the tech sector, delivering annualized returns near 17%. But you may be wondering, well, what if I start investing and then like depression's gonna happen, right? Or a recession's gonna happen? Well, I want to talk about the history, right? So the Great Depression of the 1930s saw the Dow Jones plunge by nearly 90%, wiping out fortunes and shaking global confidence. More recently, the 2008 financial crisis erased trillions of dollars in values as markets fell over 50%. Even the dot-com bubble of the early 2000s taught investors hard lessons about speculation. Despite these setbacks, history shows that markets recover and reward long-term investors. The S&P 500's average annual return since its inception in 1926 is about 10%, proving resilience and growth over time. And because I'm only 19 and I have well over 30 years of investing in my horizon, I have to keep that in mind and just stay in it for the long term. The history of investing teaches us that the market is cyclical, defined by periods of growth and decline. While crashes like the Great Depression or the 2008 financial crisis seem devastating, they also highlight the resilience of markets over time. For example, after the Great Depression, the US economy rebounded and the stock market entered a period of robust growth in the mid 20th century. Similarly, following the 2008 crash, the S&P 500 soared more than 400% in the decade-long bull market that followed. And I know we're in a bull market right now, but again, if you're young, I say you have to get in as soon as possible because it's compounding. One key lesson from history is the importance of staying invested. Investors who sold during the 2008 crisis when the S&P 500 hit its low of 660 points in March 2009 missed out on the explosive recovery that followed. Conversely, those who stayed the course benefited from the market's long-term upward trend. History also shows the dangers of speculative bubbles. The dot-com bubble of the late 1990s saw valuations skyrocket before crashing in 2000, wiping out over $5 trillion in market value. It's a reminder to focus on fundamentals, not hype, and that's the type of things I look for in the investments I make. Ultimately, the market rewards patience and discipline. By understanding the past, today's investors can navigate volatility and stay focused on the long game, building wealth over time. Now, I want to talk about what to invest in because you may be new to this. I think if you're starting out, you all just invest in an index fund, and I have a video about index funds for stock you could check out. I'll link below. But I think investing in individual stocks, I personally have funds and stocks, but having some of your money in stocks, especially when you're young, allows you to have more leverage per se. And I just want to talk about why that is. So first I want to talk about Apple, the company behind the iPhone. You might be scrolling on right now. It's one of the companies in my portfolio, and it's a perfect example of how investing transforms earned income into passive income. I'm talking about dividends. When you think of Apple, you probably think of cutting-edge tech, sleek designs, and long lines for their newest gadgets. But here's the thing. Owning Apple stock doesn't just make you a fan, it makes you an owner. And as an owner, you get paid. Every quarter, Apple pays its shareholders a dividend, a small slice of their profits. Right now, their dividend is 24 cents a share. It might not sound like much, but imagine owning 100 shares. That's $24 every quarter, or $96 a year for doing nothing but holding on to your investment. And companies that can grow their dividend year after year, that also compounds, so your passive income is going to compound too without having to sell. But here's where it gets better. Apple's story isn't just about dividends, it's about growth. This is a company that started in a garage, almost went bankrupt in the 90s, and then became the first company to hit a $3 trillion market cap. That growth drives its stock price higher over time, meaning my investment isn't just earning me passive income, it's growing in value too. And I'm not 100% bullish on Apple right now, but I do think they're a solid long-term company to have. They are slowing their growth down just a little bit today, but I still think the company is very strong and they have definitely a moat in an ecosystem where people are locked in, right? The magic of investing in a company like Apple is that I'm not just watching my money sit idle in a savings account, losing value to inflation. I'm part of a global success story, benefiting from every iPhone sold, every MacBook upgraded, every AirPods purchased, and that's what investing is all about. Turning the money you work hard to earn into a machine that works hard for you. It's exciting, it's rewarding, and it's empowering to know that your earned income can grow into something so much bigger. Why passive income from dividends is the ultimate wealth builder. So I want to talk about Domino's now. You know, the pizza company. It's kind of a boring company, but they're kind of interesting if you dig deep into them. So why do I own Domino's Pizza? More than just a cheesy breadsticks and late night delivery company, Domino's is a dividend paying powerhouse, in my opinion. Over the years, they've grown into one of the most dominant global pizza chains, and as an investor, I get to have a slice of their success. Right now, Domino's pays $4.84 per share annually in dividends. Own 50 shares and you're earning $242 a year just for being part of their journey. That's just the starting point. Here's the magic on what I want you to understand. Domino's has been growing its dividend at an average annual rate of 20% over the last 5 years. I want you to think about that. If they keep raising it at that pace, your $4.84 a share dividend could double in just a few years. Now let's zoom out. Imagine holding those same shares 10, 20 years from now. By then, your dividend payments could far surpass your initial investment, giving you a yield on cost 10%, 15%, or even higher. This is the kind of passive income that pays for vacations, groceries, or even your mortgage. But dividends aren't just about the money, they're about the mindset. They make you think long term. While others chase risky gains, you're sitting back, letting your investments generate cash flow. Reinvest those dividends, and you're building a snowball that grows bigger with every roll. And the best thing with dividends is you don't have to sell the company to get them. You just get dividends by holding it. So, Domino's isn't just delivering pizzas, it's delivering cash into my account every quarter. And this can be true for any great dividend paying company you believe in. The trick is to start now. Whether it's $50 or $500, begin building your portfolio. The earlier you invest, the sooner you'll see those dividends roll in, and one day they could fund the life you've always dreamed of. Dividend income as the path to financial independence is just something really exciting to think about, in my opinion. Just imagine waking up one day and realizing you no longer need up to cover your bills. That's the dream of financial independence, and dividend income can make it a reality. What makes dividends so powerful is their ability to generate consistent, passive cash flow, money you can count on without lifting a finger. So I want to break it down just a little further for some people who don't understand. Say you've built a portfolio worth $500,000 with an average dividend yield of 4%. That's $20,000 a year in income, or roughly $1,667 a month. Now think about that. That money could do for you. Cover rent, utilities, groceries. It might not be enough to quit your job right away, but it reduces financial stress and gives you options. And that's just the beginning. It could also help you retire earlier than what you wanted to. If you just keep reinvesting those dividends and adding to your portfolio, your income grows exponentially. Over time, the combination of reinvesting dividends and dividend growth can double or triple your passive income. For example, if a company raises its dividend by 5-10% annually, your income could grow faster than inflation, giving you even more purchasing power. The beauty of dividend income is its reliability. Companies like Coca-Cola and Johnson & Johnson, I don't own them, but a lot of probably older dividend investors do. They've been paying and increasing their dividends for decades, even during recessions. That stability allows you to plan your financial future with confidence. Financial independence isn't about becoming a millionaire overnight. It's about building streams of income that free you from depending on a single paycheck. Dividends do exactly that. Whether you want to retire early, work less, or pursue your passions, dividend income gives you the flexibility to live life on your terms. And the best part, anyone can start building this future today, no matter where you're starting from. Compounding is proof that small, consistent actions can lead to massive results over time. It's not about how much you start with, it's about starting. The earlier you let compounding work for you, the bigger your financial snowball becomes. Whether it's turning $100 a month into hundreds of thousands over decades, or watching dividends grow into a reliable income stream, compounding is the ultimate wealth building tool. It's why the wealthy get wealthier. Your future self depends on the decisions you make today. Start investing, stay consistent, and let time do the rest. The sooner you begin, the sooner you'll see the magic unfold. And I think that's it for this video. If you enjoyed it, please like, subscribe, comment down below what you're invested in. I'm very interested to hear, and I'll see you in the next one.